Hi everyone. I'd like to include in this video a video. It's only 3 minutes long, made by a chap called, I think his name's Warren Pollock, and he's got a YouTube channel which I'll put a link to in the more info section. I think the channel name is wepollock. Anyway, I think it's really good, and it ties in with some of the videos that I've made recently regarding the importance of the Treasuries market and well, my theory that unless stocks crash and drive some cash into treasuries, all hell's going to let loose on interest rates, and thanks to the treasury market. But anyway, I'll just let this video run in a few seconds. But just one more thing. I've noticed on TLT, which is the ETF tracking the 20-year plus treasury notes. They are really being priced, the options that is, for the thing to crash. I mean, for example, the way options pricing works is that an option which is at the money, which means that let's say the strike price, let's say that the current price is $100 on something, and you look at the $100 strike price, which means that call buyers can buy the stock for $100. Put buyers can sell their stock for $100. So, in other words, it's at the money, at that mark. Now, normally the calls and the puts are pretty much the same price, irrespective of however you might think that they'd be priced because you think the stock's going to go up or down or whatever. That's how options work. They pretty much are about the same price. On TLT, that ETF, that's just not the case at all. The puts are around double the price of the calls. People are paying a lot of money to bet on the downside on TLT. Not only that, but the stock available to borrow, in other words, the stock available for short sellers to borrow and sell into the market, is what's called hard to borrow, which means that there are special requirements, and you have to, at least for people like us, ordinary people, we need to make a special request to the broker, and they'll try and find some stock somewhere. In other words, the thing is absolutely stacked high with people expecting and putting their money behind the idea that the bond market, the long-term bond market, is going to crash. Now, obviously when a lot of people are on one side of the trade, the contrarians would say, well, that's the time to look at the other, which is why I think this video that I'm going to show you is extremely interesting. Because that would imply that if the markets crash, perhaps money will seek safety again back into the bond market and prop it up again, which would help the Fed enormously. So they'd like that to happen, I think. Anyway, I'll let this video speak for itself. I think it's well worth watching. Thank you.
We saw the US dollar really lose its grip on reality today and break down catastrophically. At the same time, we saw the stock market break down as well. So what I've done today was basically to draw up a grid for you, and it has four potentialities. US dollar up, stocks up. And that's where we were during a real bull market with increasing growth, increasing profits, international capital flows into the United States, activity-based inflation, and labor deflation from China. And that progressed to really an era of where the internet boom was replaced with a real estate boom, complete with deregulation, and that was with the US dollar going down and stocks going up. And that's a faux bull market, baseball card economy, oil more expensive, inflation, low productivity, declining living standards. We've transitioned from that to a period where we had the US dollar up and stocks down. And it's basically a flight to bonds for safety and a deflationary outcome. And in this recent rally, we've moved from there back to the US dollar down and the stocks up scenario, where we have really a faux bull market economy as they're trying to buoy up the financial system. And we're looking at oil getting more expensive, inflation, low productivity, declining standards. The baseball cards aren't in real estate now, they're in finance. And it seems to me that we may have seen a change today. And I'm hoping that we'll go back to U.S. dollar up and stocks down, because the alternative to that is really U.S. dollar down and stocks down, which is what occurred today. It would be a rush out of the U.S. dollar and bonds, a rush out of the U.S. dollar stocks. It would be a total crisis, hyperinflation, total dislocation, the kind of thing that happens in the third world. And I'm not saying this is going to happen. I think that this ball or pendulum or spinner of derivatives is going to land in one or two places, either with the U.S. dollar going up and stocks going down, or it's going to land into a hyperinflationary outcome. And it's very, very interesting to me. We've been able to have this sort of rally, and it's been totally a full rally of a different color entirely. So we'll see where we go. The derivatives may be the last shoe to drop, and we might see this happen very, very quickly. I think that we might bounce back into the U.S. dollar up, stocks down category as people sell stocks and get into the U.S. dollar treasuries as a flow of safety, or we're going to see international people have a wholesale strike on U.S. dollar assets, and we're going to go the way of Great Britain or Iceland even. It's going to, or Argentina. So let's see where we go.